So today we're going to spend the next 45 minutes or so just talking about the current state of the market using option indicators or the other indicators that we look at in terms of predicting the market. Just a brief bit about our company to start with. We're a money management firm. We've got currently a little over 85 million under management as both a CTA and a RAA. These are individual option accounts. We started out 27 years ago as a derivatives research firm, and we still do put out research. We put out newsletters, etc. And then we do a certain amount of option education as well. Talks like this or mentoring. Also, we offer mentoring. If you go to this website here, optionstrategist.com/inspire, you will be able to register to get the PDF of this seminar. And also, as I'll explain later, there's a bonus. There's some discounts there, but there's a bonus white paper that I just published recently. So let's get to the heart of it here. There's four main indicators that I use. We'll go into these in some amount of depth. Obviously, the chart of the S&P 500 is the most important thing, really. I mean, if you have indicators that are telling you something different and the chart's trending the other way, the chart is the king. We also look at equity-only put-call ratios, look at market breadth, and we look at volatility, primarily VIX, but some other things concerning VIX as well. Before we start, you're going to see as we talk about this that there's a few indicators that are overbought. Overbought does not mean sell. If a market can get overbought and stay overbought for a long time, we'll look at some examples of that. So, and conversely, oversold does not mean buy either. So I'm a big fan of waiting for confirmed signals rather than jumping in because you think a signal is about to happen. So here's the current chart of the S&P 500, and there's two important things on the chart. The first is this trend, which is noted here by the blue lines, and they form the series of higher lows and higher highs that's been taking place since late March. And that is the channel, the upward channel, the bullish channel that SPX is in. And as long as it's in that channel, obviously the trend is higher. The 20-day moving average is higher. Everything is pretty good. Now, within that channel, there is a resistance area here at the old high, which was back in January at 28.72, I believe. And then just this week, we hit 28.73. And really the two are only about 40 cents apart. So there's resistance there at those old highs. And then there's been a number of support and resistance tests of the 2800 level, which is the other horizontal red line here. At first it was resistance, then once it breaks through there, resistance becomes support. So now we've tested this a few times, including a week ago, Thursday, when we came down there and tested it, and then we bounced strongly off of there. So as you can see, as we move a little farther to the right here, as time passes, this 2800 level is going to pretty soon be the intersection of the trend channel and the support level. So if we were to break below 2800, that would be pretty negative. This is a 200-day moving average down here. It has provided support several times along the way. It hasn't been tested real recently, but it's pretty typical that if a market does roll over into a bear market, it will eventually bounce off the 200-day moving average a few times as it has. Then it will fall below it and it'll act as resistance. So right now, everything looks pretty good on the S&P chart. It's in the uptrend channel. You know, a strong breakout to new highs would be a bullish confirmation. We did not get that yet. Just making a new high by 40 cents is not a confirmation of a new upside breakout. And the 200-day moving average will be, of course, important if it does get tested. But right now, we're considering the S&P chart bullish as long as it stays above 2,800. But a failure at 2,800 would be bearish. So another thing that we look at is modified Bollinger Bands. And what do I mean by modified? Well, Bollinger Bands is something invented by John Bollinger. And in order to calculate Bollinger Bands, you need to calculate volatility. So he defined volatility as the standard deviation of closing prices, which certainly sounds rational and makes some sense. Unfortunately, in the math world, that's not always the case. So in the Black-Scholes model, for example, which we have to use because we're option traders and we price implied volatility and everything else, all the theoretical values off the Black-Scholes model, our definition of volatility has to agree with theirs. And their definition is volatility is the standard deviation of daily percentage price changes. And so it's not a huge difference, but it is a difference. So using that definition of volatility, we come up with modified Bollinger Bands. So you can see them here. And the top squiggly line is 4 standard deviations above the 20-day moving average. This line right here is 3 standard deviations above. The lower line here is 4 standard deviations below, and the one in just inside of that is 3 standard deviations below. So we've created a system based around this, and the system is that once you break outside, let's say on the upside, you break above the 4 sigma line and then close back inside the 3 sigma line, that's a sell signal. So right there was a sell signal. Obviously that was a pretty good one. And we've had a couple of buy signals down here similar. So on this chart, the red letters indicate successful signals. Let me just get rid of some of that writing. The blue are not successful signals, although you can see this buy in early February was quickly followed by a successful signal. And then most recently, we had a sell signal in late July right here, and the jury is out on that. So that's in green until we get a little bit of handle on whether that is going to work or not. You can see we had a series. First of all, taking sell signals in December is always a bit of a risky proposition, so we didn't really trade those. But this one, we take a sell signal there. It stops itself out. The system that we use has certain stops to it, so these are all stopped out fairly quickly. It's a system that we follow in our newsletters and have a pretty good track record with. Anyway, so that's currently on a sell signal, and it would be stopped out if the index rises back above the 4 sigma band. Let me just back up so you can see right now that 4 sigma band at the current time is about right here at about 28.85, I think it is. It's kind of contracting a bit because volatility is decreasing right now, and it moves, of course, every day. But if S&P were to suddenly gap up above 28.85, that signal would be stopped out, and a new one would set up at some later time. But you can see that could be quite a bit later. I mean, technically, this sell signal from late December, this one right here, was stopped out right there. And then the thing climbed. It was above the 4 sigma line all the way up there till almost a month later when we finally got a good sell signal. Okay, so much for the S&P chart. How about put call ratios? These are something that I think very important, and we use equity only put call ratios to predict the broad market. Equity only meaning all stock options that trade, so not index options, not futures options, but just equity options here. And the theory is this. I mean, the theory of using put call ratios was invented by Marty Zweig back in the late 1950s. And at that time, the only volume he had to go off of was the weekly ads in Barron's by the put and call dealers. And, they were very small numbers, like maybe trade 1,000 calls and 800 puts on the week. And I would trade that in the first 5 seconds or 1 second. But anyway, it's a contrary indicator. So if there's too much put buying going on, then everybody's bearish. Everybody's buying puts. And therefore, we want to do something bullish. So it's a contrary indicator. Conversely, if there's too much call buying going on, then everybody's bullish, and we want to do something bearish. To calculate the standard put call ratio is very simple. Let's say it's IBM. At the end of the day, we sum up the volume on all the puts traded in IBM. Separately, we sum up the volume on all the calls and divide the two, and it's the put-call ratio. Since puts are in the numerator of that fraction, heavy put buying, which would typically take place in a down market, sends the ratio higher. And since calls are in the numerator of the fraction, heavy call buying will send the, calls are in the denominator, heavy call buying would send the ratio lower. So it works inversely to the market. I'm not sure why Marty didn't call it a call put ratio, but he called it put call. And pretty much everyone adheres to that same definition. You can sometimes find a website or two that will show you the call put ratio, but typically people just look at the put call ratio. We smooth it out using a 21-day moving average. Why 21 days? Well, just in case there's something to Fibonacci. But you do need to smooth it out a bit because the numbers are quite volatile in the series of daily put call ratios. So in theory, this is what you should have. Let's say as the stock price is falling, people are buying puts, sending the put call ratio higher. And so during the trend, the public is right, everybody's good. But at the peak of the trend now, here, everybody is pretty much loaded up on all the puts they can buy or want to buy. And the put call ratio rolls over and starts to head down. And that is a buy signal for the stock. And then people start buying calls and the put call ratio falls. So that's what we'd like to see. If you're looking at a chart of the put call ratio, you should be able to see this mirror image. If you don't, and there's something distorting that chart, we'll see that a little bit later. We post about 400 plus charts on our website every day in an area called the strategy zone. So they often, those are given pretty much without comment. In our newsletters, we do comment on them and make recommendations, but we are calculating a lot of put call ratios on a daily basis. So this is not the current chart, but this is just the chart of the S&P on top and the equity only put call ratio on the bottom. And you can see the inverse symmetry that exists most of the time, not 100% of the time, but most of the time. And so that indicates this is a pretty good indicator for the broad stock market itself. So here's the current ratio, and you can see, for example, last year there was a lot of call buying going on in November and December, and even as the market kept going higher and higher, there was a little kind of fake out there, but then eventually the ratio came all the way down here, which was the lowest it had actually been since, in almost 4 years. And eventually the ratio bottom formed the local minimum on the chart, which is a sell signal for the stock market. And of course that coincided with that. And then we've had, then everybody started buying puts, of course, back there in February, and that reached a buy signal and then a second buy. Now what's happened? Well, as we got into late June, the ratio started higher again, but so did the market. And so what we have right now is a period in which the market is rising and the put call ratio is rising. So they are no longer have the inverse symmetry. As I said, this does happen from time to time. When it does in a particular put call ratio chart, you just stand aside and wait till the inverse symmetry reinstates itself. What causes this? Typically, it's caused by either arbitrage, which is not, of course, going to take place in the broad market, or hedging, and that is taking place. So right now, people still remember this violent drop in the market back here in February, and they're buying puts, out of the money puts, especially the low price puts, even though they're overpaying for them, and that's forcing the put call ratio higher because they're buying puts, even though the stock market is going higher as well. Now, with the advent of computers, we're able to calculate another kind of put call ratio called the weighted ratio, and in this case, we measure the dollars being spent on puts versus the dollars being spent on calls. So at the end of the day, we take each option and I multiply its closing price times the volume traded that day. Now you could do this on a trade by trade basis, but that seems like overkill. So again, let's say it's IBM, we make that calculation for every option, and then we sum up that dollar volume figure for all the puts. Separately, we sum it up for the calls, divide the two, and again, now we have a weighted put call ratio. So now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion, and in general, this is a better indicator. The timing is usually better. But we watch both because the other one is still valid at times. So again, you can see here, this one gave a few more, gave a few more wiggles last fall on the way down, but eventually did reach the lowest level it had reached in 8 years, which is very surprising because over time put-call ratios tend to rise. The equity-only put-call ratio tends to rise over time because more and more people figure out that you can buy puts for protection. That doesn't help us with as a contrary indicator, but it just makes the general level of the put-call ratio higher. So for it to drop to an 8-year low reflects just a massive amount of call buying, and of course that really eventually resulted in the sell signal from last February. Then again, we came up here, and now the market sentiment had reversed that. By the time we got into mid-April, we're trading at the highest put-call ratio in a couple of years, and that was a buy signal. And we went sell signal, buy signal, and now we're having the same effect here. So even though people, the weighted ratio typically is not as susceptible as the standard ratio, the other one we looked at, to people buying a lot of out-of-the-money puts, we're still seeing this ratio move higher. At the same time, the stock market's moving higher. So again, this one has a beginning at least of non-inverse correlation. So right now, I'm viewing these sell signals on the put-call ratio with a bit of skepticism, let's just say. So we had the good buy signals in April. They led to these ratio sell signals in June, and those have really not been too effective. So we're watching this one, but I'm not counting this as a major indicator right now in terms of how we're scoring the market. So let's look at some individual put call charts. In our newsletters, the Daily Strategist and the Option Strategist, we make recommendations on these, and we've been pretty successful, especially in the last few years, where we've been using extremes on the chart to generate a signal. I'll show you what I mean. So here's Micron. Let's just take the leftmost signal here, the one over here. Micron was moving down, not quickly, but moving down. And people, though, were buying puts very heavily. And eventually the put call ratio rolled over, and that generates a buy signal. Well, like, what's the difference between that one and, say, this one, which I haven't marked? Well, this one occurred at the 95th percentile of all previous data points. I can't see all the previous data points, but that ratio is very high compared to other wiggles in the put call ratio. So that's a buy signal, and of course that was an excellent one. You can see we came pretty close to that same level, had an excellent buy signal there. Again, got up to that same level, had a good buy signal there. And then about a month ago, we got up to that same level again and had a buy signal, and that's, again, using my color coding. That was not a successful signal, but it was followed just last week by another buy signal, and so we now have a new buy signal here. Remains to be seen how it will work out, but not every signal works on these, of course, but they do have a very good track record when you use the extremes. And what we're doing here is we often compare, have the previous extremes worked well? If they haven't, then we're not so interested in taking the signal. But these here, the buy extremes seem to have worked pretty well, 3 out of 4, and so we've taken this new one. Here's another one that was just crazy. The Brazil ETF, you may recall earlier this year when the emerging markets were really taking it on the chin. The put call ratio, the index, this is the EWZ, the ETF, it was falling sharply, but it wasn't really until late May that the people really started buying the puts, and into June, and the put call ratio got up to 800. Well, this is a weighted ratio. In the title of the chart, you can see whether it's weighted or not. So that means $800 are being spent on puts for every $100 being spent on calls. That's an insane ratio. It rolled over as a buy signal. It worked out okay. We made money on it. I wouldn't say it was the best buy signal in the history of mankind, but you can see that during that little rally here over the next 6-8 weeks, the call buying was extremely heavy to the point where we came down all the way down here, got all the way down nearly to 100 and curled back up, making a local minimum, and that's a sell signal. So we sold out of the ones that we had been long, and you know, we did not take the sell signal per se, but you can see these other sell signals worked out fairly well from the chart. So again, extremes on the chart is what we're looking for. Here's a new signal that we just issued the other day in Ulta Beauty. You can see that the ratio, even though the stock was not really falling, it fell there, had a little recovery, and it fell again. But people were buying puts very heavily all through that time period, and eventually peaked up here at the highest level on this chart, and actually the highest level in several years. And so that's good enough for us for a buy signal. So we bought that. I saw the stock was doing pretty well today. But we are generally in these until the put-call ratio reverses. We may roll up, let's say, to a higher strike on our long calls or something like that. But we're not normally just in these for a short trade. Sometimes we're in these for weeks, maybe even months, as long as the trend persists in the put-call ratio and in the stock. Here's another one, Disney. You can see the lows now. This low here was a 95th percentile low at the time. We've since gone lower, and then this one was the 95th percentile at the time, and now we've just had another one here. So you see the other two sell signals were okay. You know, Disney is not going to collapse probably, so you take a small trade. The options are not expensive, and so it doesn't take a large move to produce a pretty decent profit. And so once it broke down through this level right here, we're taking the sell signal there. Also, this one might be a bit surprising to you is Google, but Google did break down through a level here and did give us a sell signal at a very extreme level. It had given one there about a month ago, which really didn't work out, but we're playing this one. And so there are many others, but those are the current most of the current ones that I'm seeing as extreme charts and worthwhile checking into. All right, so the third thing we look at is market breadth, and simplistically, breadth is just advances minus declines. You can do a few things with it. You can keep a cumulative total, where we do that. I'll show you some examples there. You can also calculate an oscillator. But before we get into that, let me talk about what actually constitutes breadth, because on the New York Stock Exchange, there's a bunch of things that are not stocks that trade, and yet the New York Stock Exchange breadth figures, when they just put out a New York Stock Exchange advances minus declines, it does include those other things. So we first noticed this in an extreme way right here about this time in 2001. To us, the market looked pretty weak. And yet I was watching TV, I guess, and somebody said, well, the New York Stock Exchange advanced decline line just made a new all-time high. And the cumulative advanced decline, I said, what? How could that possibly be? And then I realized, what had happened was that's when decimalization was first taking place. And so there's a bunch of preferred stocks on the New York Stock Exchange. So you might have had a preferred that was trading at 80, and the next tick before decimalization was 80 and an eighth. Well, a small change in interest rates is not going to get that to change. But if the next tick is 80.01, then maybe a small change in interest rates would get that to become an advancing issue. And that's exactly what was going on. Decimalization came in, the Fed was lowering interest rates, so we got a lot of advances out of those things. So we said, look, there's got to be a better way, and we've got a great set of stocks to look at, and those are stocks that have options on them. So we created our own stocks only data set using optionable stocks, and you can see at this time how the stocks only advanced decline line was decreasing badly, whereas the New York Stock Exchange one was advancing, and it turned out, of course, this one was better. We were in the early stages of what was a very nasty 2-year bear market. So we'll return to that in a minute, but we do also keep an oscillator, and the way we keep the oscillator is this. Today's value of the oscillator is called M, is equal to 90% of yesterday's M plus 10% of the advances minus declines from today. So this swings all over the place, but we do pay attention to it. We watch it for both stocks only data and New York Stock Exchange data, but the stocks only data is shown here. So a couple of things. First of all, if it gets above plus 200, this oscillator is considered to be overbought. But remember, I said overbought doesn't mean selling. So you can see that it got overbought right here. This was coming out of a very nasty sell-off in January and February of 2016, and then the market roared upwards. It stayed overbought that whole time. It didn't really come out of the overbought status until down in here, and that's when we got a sell signal. So while the market is overbought, it can still go up. Where do we stand right now? Well, we just recently got overbought again, and with the market trying to break out to new all-time highs, you can see here we're still working off that kind of resistance area. And if the market were to break out here to new all-time highs, we'd want to see this get very overbought, just like it did back there or back there. That's a good thing in terms of a market breaking out to new highs. On the other hand, if the oscillator falls below minus 400, it's oversold. You can see this goes back to 2013, so 5 years or so. We haven't had too many oversold conditions back then. In fact, now they're pretty rare. We don't hardly ever get them. But all of these are pretty good buy signals when they occur, because mostly in the last couple of years, any buy signal's been a good buy signal most of the time. Now, so as I said recently, these breadth oscillators have moved into overbought territory, which is a positive thing. So they're on buy signals and they're overbought. That doesn't mean they're on sell signals. So we'd have to wait until they went to a sell signal somewhere along the way before we could act on them. So again, overbought does not mean sell. One other thing about these, they swing back and forth pretty quickly. In a slow-moving market, that can be a bit of an annoyance, but in the fast-moving market that we've had so far this year, especially earlier this year, they were pretty good timing on the signal. So again, waiting for a sell signal here, but who knows when it will come. Now, cumulative breadth is what we talked about before, where we just keep track of the advances minus declines each day, and we keep adding them up. And so we do that for both stocks only data and New York Stock Exchange data. And the one thing that pretty much all technicians agree on is that if there is a negative divergence between SPX and the cumulative advanced decline line, then that's a bad thing for the market. So if SPX were to be making new highs, but the cumulative AD line, let's say, peaked and then it was starting to fall away from that, that would be a negative divergence. That would be a sell signal. When you do get that condition, especially if SPX is near all-time highs, you better be prepared. And it can stay that way. Again, that would be, let's say, the overbought situation. You'd want to wait for a confirmed sell signal break of support or something like that. But that's a very negative thing. We don't have that now. But what we have is the opposite. We have SPX making new highs. So we have SPX doing this. And we have the cumulative AD line also making new highs. And so what does that mean? Well, a lot of technicians will tell you that's bullish, that's confirmation. In fact, it turns out, and I'm going to show you some charts later, it's not. It doesn't really mean much of anything. So if you have the negative divergence, a negative divergence does precede a bear market, but not every bear market begins with a divergence. So there's nothing in this formation here that would prevent that from happening. So let's just, I have data that can back that. I know a lot of people are saying because the cumulative advanced decline line is making new all-time highs, it's an all clear ahead for the market. Not true, but we'll get back to that later. So here's the current chart. The yellow line is the cumulative advanced decline line. The white line is SPX, and you can see that the cumulative advanced decline line has been, it topped out there in early February when the market sold off. Oh, I'm sorry. That was actually earlier. But it came roaring back, and all this year, even in March when the market was still struggling, it started making new all-time highs. So it's been making a lot of all-time highs. And so the negative divergence thing does not exist. So there's not a sell signal because of that, but the other condition doesn't mean much of anything. The market could still go into a bear market without a negative divergence. Not every bear market is preceded by a negative divergence in the advanced decline line. All right, so that's the third thing, breadth. The fourth thing is volatility. And the number one thing we look at in terms of volatility is VIX. The VIX indicator. VIX was invented by the CBOE back in 1993, and it's gone through a variety of different formations over the years, but they're similar to each other. So two things. Let me back up. The trend of VIX is important. So when the market is dropping, VIX will be trending higher. So if VIX goes into an uptrend, that's bad for the market. On the other hand, if VIX is trending down or sideways, that's okay. Then the market can rally. So down or sideways is bullish. Spike peaks in the VIX, and I'm going to show you some of those. Those are definitely bullish, the buy signals. And you know, if VIX gets really low, people start to say, "Oh, it's too low." Well, again, to me, that's just one of those overbought conditions. You know, VIX can get low and stay low for a long time. It did it all last year, and it's getting pretty low again. But the market can continue on upwards while VIX remains low. It's only when VIX begins to rise, begins to break out to the upside, that you have to worry about things. So again, overbought. Yeah, low VIX is overbought, but that's not a sell signal. So here's the current chart of VIX going back to last year. And two things on this chart stand out. Well, maybe three. So number one, right now, VIX is just kind of trending sideways. There's no trend to it, so that's okay. Stocks can rally while that's happening. Number two, this 15 line here, put a red line here at the 15 level on VIX. It has acted as support or resistance just a whole bunch of times over the last year. And a couple of times we sliced through it. Even a couple of weeks ago, we sliced up and right back down. But to me, that's pretty significant. So as long as VIX is below 15, I don't think you have any worries about stocks. If it gets above 15, you'll be worried a little bit. If it gets above 19, which is where it was here, you should worry a lot. Now, I said spike peaks in VIX are buy signals. So that's here, you know, we had the big one in February up and back down. So every one of these is a spike peak buy signal by a definition, a rigorous definition that we have. And one occurred last week on August 10th when we went down and tested that 2,800 level and bounced up off that. VIX went up during the day to almost 17 and closed back down in here. So we're on this buy signal. And while these have all been successful, and so I've marked them as red, they've been more successful in the early days of their signal than in the later days. Technically, the system that we've created says these signals last for about a month, 22 trading days specifically, but it's been the first 8 or 10 trading days generally produce the most profits, at least this year. So again, we follow these in our newsletters, and this is a system that we rely upon heavily when it gives signals. And you can see it only gives a signal, you know, maybe once a month or even less. Now, so the current state of the VIX is this. The VIX is flat, below 15, kind of just trending sideways, so that's bullish for the market. It gave that new spike peak buy signal a week ago, and so as long as it's below 15, not a problem. So all that's bullish for the market. Now, there's something else we look at in terms of VIX, and that's the VIX derivatives. So there's a number of VIX derivatives, but specifically here I'm talking about the VIX futures. And also we're going to look at the term structure of the futures as well as the CBOE volatility indices. So if the futures are trading at a premium to VIX, so the futures are trading higher at a higher price than VIX, and the term structure slopes upwards. In other words, like right now, September futures are the front month, and then October is higher, let's say November is higher, December is higher. So the term structure slopes upwards as we go look at the various futures months going on in time. That's positive. That's a positive sloping term structure, and let's say the futures are all trading at a premium to VIX, maybe VIX is down here somewhere. That's bullish for the stock market. When the opposite well, that's been the case for a while now. So this indicator is bullish. When the opposite occurs, if the term structure starts sloping downwards and they're below, the futures are trading below the price of VIX, that's very bearish, and you should definitely be short the market or out of the market or heavily protected when that situation occurs. In case you're wondering, this year on February 1st and February 2nd, right before the market really took the big hit, the next couple of weeks, this did occur. The term structure went into this shape, and it was a clear warning sign to, take cover. Here's where things are as of last night. VIX was trading at 1225, not as low as it was last year, but still pretty low. And you can see that the VIX futures here all trading at a price higher than VIX. In fact, the premium on each future is shown here to the right. So if we take the price of the future here, 14.18 minus the price of VIX, we get $1.93. So these are all plus, meaning they're all trading at higher premiums or higher prices than VIX. That's bullish, and you can see that each one is trading for a higher price than its predecessor. So the term structure is sloping upwards. Again, bullish. So these are all bullish things. And don't buy, if you hear some guy on TV tell you, oh, well, VIX, VIX futures are much higher here next April. So futures traders are expecting VIX to increase by April. That's not true at all. That's not what this is telling you. And so just don't even listen to somebody that's saying that. I don't have time to go into it all here, but that's not true. If you don't have access to the futures, although the delay quotes are free on the CBOE futures website, cfe.com, you can look at the CBOE's volatility indices. And so the current symbols for these indices, and those symbols change. They used to be these ones shown down here. But currently there's a 9-day VIX, and it's right now trading at 1077. There's the regular VIX, which is a 30-day volatility measure. As we saw, that's trading at 1225. There's a 3-month VIX that's trading higher. And then there's even a 6-month VIX trading even higher. So you can see again here, the term structure is sloping upwards as we go out in time. Again, that's bullish. So the VIX futures construct is bullish. The CBOE indices construct is bullish. VIX is trending flat to lower. That's all bullish. So let me wrap up the market opinion, but I do have another subject that I want to cover. So as of today, the SPX chart is bullish. It's in that rising channel, and it will continue to be bullish as long as it holds above support at 2,800. The put-call ratios technically are on sell signals. I put a question mark there because, as we saw, they're trending in the same direction as the stock market, so they're in a bit of, hiatus, let's just say right now. The breadth oscillators are on buy signals, and they're in overbought territory, but not yet on sell signals. The VIX itself is bullish because it's trending lower. The term structure is bullish because it's trending higher. And so all in all, everything here is bullish except for possibly the put-call ratios. And so as long as SPX holds above support, we're continuing to view this as a bullish market. Now, I wrote an article last week on this subject. Could there be a double top forming? And then I saw one just the other day. Somebody sent it to me. Someone else had written a similar one. To me, 2000 is the very interesting time. In 2000, we had the culmination of this huge stock market rally, and then the tech bubble and everything else reaching extreme highs in March of 2000. And then after the market kind of struggled a little bit there was a huge down day in the market, maybe even 2 days, where the tech stocks got massacred. Rumors were that Soros was selling out all his stocks, and it was not good for the market. But then the market righted itself and rallied and got back to the highs. And then a huge 2-year bear market started that cost 50% of the value of the S&P 500. So could that be the case again? Well, let's see. I mean, you know, we can't just look at one chart and say, oh yeah, that could be. I mean, it could be, but let's take a look. First of all, what did the S&P chart look like? So back here, the S&P chart closer up, there was a modified Bollinger Band sell signal, and then a buy signal, and then this uptrending channel again, lower, higher lows and higher highs, pushing the index up until it almost got back to its highs, and then it failed. But the real failure didn't come until the bottom of the channel was broken. Once it did that, then you had some problems. And you can see there was kind of a battle going on here inside this circle where the market traded sideways for a while, but then broke down eventually. So here we are today, same chart as I showed you earlier. We're in this channel. We've come back up. We've tested, you know, the same resistance level, and so far that could be similar. Now we'll see if we break out up here, then that would change things dramatically. But if we fall back below 2,800 and get down in this area, then there would be a big problem. So this, you know, not completely dissimilar. However, this is different, and to me, this is a big difference. So back in 2000, the tech stocks, meaning QQQ specifically amongst them, as an index, had run to the new all-time highs. They fell back badly on that sell-off, and then during the rally, they did not get anywhere near their highs. So there was a big negative divergence there between the S&P 500, which did get back to its highs, and the Qs. Same thing with the Russell 2000 index. Again, this is in 2000. It did not get back to its highs. So again, a big negative divergence. Here's where we are today. The Qs topped out as with the market, but then went on to make a new high in March, and then made more new highs recently. Same thing with the Russell 2000. It topped out, came back, equaled that high, but then now has broken out strongly, and now just this week again made another new high. So that negative divergence between the Russell 2000 stocks and the NASDAQ 100 stocks and the S&P does not exist now. To me, that's a big difference, but it might not be the only thing. How about the cumulative advanced decline line? You know, I just gave you my opinion before on that, because here's where we are now. Every one of these stars is a new all-time high in the cumulative advanced decline line, and a lot of people are saying, well, that's safety for the market. The market's going to go higher because of that. But you can see here that in 2000, the cumulative advanced decline line got up there, and then when S&P got all the way back almost to its highs, the cumulative advanced decline line also got back almost to its highs. Certainly no significant negative divergence, and yet we went into a 50% bear market. So that's why I'm saying that, you know, just because you don't have a negative divergence doesn't mean you can't go into a bear market. In other words, not every bear market is preceded by a negative divergence. So all of these new highs here, they're nice, but to me, not particularly meaningful. How about VIX? In those days, in 2000, VIX was called VXO. It was what we now call VXO. It was called VIX then, but now we know it's VXO. And you can see that it's these are various spike, peak, buy signals, all that stuff. It spiked up very high and during the sell-off, and then came down very low in the summer. In August into early September, made new lows. Now you can see the entire, I mean, here probably the average price for VIX in those days was near 30, certainly in the high 20s, much different than today. But it did make a new low, and that didn't save it, because when it started trending higher, and remember I said when VIX starts to trend higher, that's bad for the stock market, and boy, it wasn't. So then every time that S&P broke to new lows, you can't see the S&P chart here, VIX just exploded to new highs, and of course this was 9/11, which just made things worse, all in the middle of what was an ongoing bear market. Here's where we are today. Of course, everything seems copacetic. VIX is at lows, but if VIX starts trending higher, as it did in September of 2000, that would be a very bad warning sign. So these two charts are similar enough that I think, you can see that, it's something you need to pay attention to, the trend of VIX. I don't have charts on all the rest of these. The pick-out ratios were both on sell signals now and then. The breadth oscillators are stronger right now than they were back then, but that still doesn't mean we can't roll into a sell signal. New highs, new lows, pretty similar in both cases. New highs are outnumbering, but not by a lot. And the 200-day moving average. This year, it's been stronger. I mean, every time we touched it this year, the market has a big rally. Back then, it was going below the 200-day moving average and then rallying, but eventually it rolled over. So it seems stronger now, but the main difference is, to me, is that the fact that the QQQ and the Russell 2000 stocks are not don't have that negative divergence. But in any case, there's enough similarity here to where I don't think you can just hang your hat on something like the cumulative advanced decline line and say, oh, well, it's making new all-time high, so everything's great, and I don't care if the market pulls back by 15%. Well, you should. So pay attention to the technical levels on the SSPX chart. We showed you 2,800 is the one level. That's only 3% from here. So you risk 3%, but if it goes below there, stop risking. It's time to take some action. This full report that I wrote on this is a 9-page report, and it is available for those who subscribe to the Option Strategist newsletter. So as I said before, if you go to this website, there is a half-price subscription for 6 months of the Option Strategist newsletter for $99, and that's that will give you access to the report, plus all the other things that come with it. And if you register on this page, we will email you the PDF of this seminar. There's my contact information if you need to get a hold of me. If you're interested in money management, our money management, you may want to look at this website as well, McMillanasset.com.